Hello and welcome. You have tuned into Buy Now, Sell Now on ET Now. I'm Shrishti Sharma and with me Cheryl D'Souza. And viewers, this is the show where you get answers for all your stock-related queries. In a short while from now, we will connect with our experts. But before that, let's quickly take a look at what the markets are up to. So Cheryl, first day of the week and the volatility continues. As of now, we are still holding itself in the green for Nifty 50.
Absolutely, Shrishti, a very good morning to you. Actually, a flattish day of trade coming in for the benchmark indices. If you look at it on your screen, as you can see, we are actually just seeing gains of about 0.3%, while Nifty Bank is in the negative territory, underperforming the benchmark. Moving in trade today, we have Tata Motors, that is the top gainer on the Nifty, 7% uptick coming in for Tata Motors on back of stellar set of numbers coming in for that particular counter. But on the flip side, UPL is also reacting to its earnings, and UPL in fact is down about 7%, making it the top loser on the Nifty, 7.8% right now actually, and it is drifting even much more lower. Talking about the other list of gainers, then you have Coal India, BPCL, ONGC among the top gainers. Along with that, add to the list Sun Pharma also is seeing good gains. While on the flip side, apart from UPL, you also have Bharti Airtel, HDFC Life, Kotak Mahindra Bank that are in the negative territory. Let's talk about the sectoral indices and see what's happening in that particular arena. And if you look at the sectoral indices, the FMCG index, that's the sole loser when it comes to the sectoral front, while on the flip side is the PSU sector in particular, that is the top gainer. Along with that, you have Pharma, Realty also holding on to strong gains. So that's the way how the markets are looking like at this point in time, Shrishti. Yes, a bit of flattish day of trade coming in for the benchmarks after hitting record high levels on Friday.
All right, then that's how the markets are up to. But viewers, we will get all your stock-related queries answered on the show, but in a short while from now. But before that, we have a lot of managements that are also lined up on the back of the earnings as well. So let's get started. And the first guest for today is Mr. Karvinder Singh, who is the MD and CEO at Mahindra Holidays and Resorts. Hi, sir. Very good morning, and thank you so much for your time. First of all, apart from the numbers, there are significant changes in the key appointments at the top management level following your exit news as well. So share the rationale and what's in the store for Mr. Manoj Bhatt.
Yeah, so as it is well known by now that I have taken a decision to move on and look at the new challenge in my professional journey after being at the helm of affairs for almost 9.5 years. Mahindra Holidays, on 2nd February on Friday delivered the highest ever quarterly numbers, third quarter numbers. Even on 9-month basis, we are trending at the highest ever numbers, both at income, EBITDA and PBT levels. So we are in a very good shape. We have 1,300 crores of cash and we have crossed the 5,000 mark in terms of rooms. Now we are at 5,129. And we have a member base of about 2.93 lakh members. So it's been a very, very good journey. Our market cap is also at about $1 billion market cap. When I came in, we had about $200 million market cap. So it's been a great journey, very happy journey, very happy working with, stalwarts like Mr. Anand Mahindra, as well as Dr. Anisha. So it's been a great journey. So as I move on, Manoj Bhatt, who is our group CFO, my dear colleague at the Group Executive Board, is taking over from me on Mahindra Holidays on around 17th May. So this is something that the group believes in building the talent from within. And as a result of that, Manoj gets an opportunity to run a business. So this is a welcome move. It gives the right signal that group has enough depth of talent. So I think Mahindra Holidays is a very strong position, and my moving on to take on my challenge is purely my personal decision. And obviously, with the group taking a decision to get Mr. Manoj Bhatt in this position is also a very, very welcome move. I do see great future for Mahindra Holidays in the times ahead.
Good morning to you, Mr. Singh. This is Cheryl also joining in the conversation, and we did speak to Anisha also in depth regarding the changes that were happening at Mahindra Group level. And he did say that they are trying to incubate a lot of talent, in-house talent, and also make Mahindra Group a powerhouse of talent. And also he was pretty bullish about Mahindra Holidays and the prospects going ahead, and your earnings are also reflecting that. So if you have to talk more about the earnings, if you tell us what actually drove the profit in the quarter gone by, and also what's your outlook going ahead for the margins in particular?
Yeah. So let me start with the margins. I think margins, EBITDA margins at 30.5% turned out to be great. This is a very, very strong quarter. October, November, December is generally a seasonally good quarter at a standalone level. But having said that, we definitely exceeded our own expectations. EBITDA margins are up by about 120 basis points, and this excludes all the one-offs. So if you were to look at on an operational level, there are two things that are driving our margins. Number one, our cost of acquisitions are steadily coming down. If you look at pass through the numbers, and most importantly, our referral and digital are now trending at about 57% of our sales is coming through referral and digital, which means lots of our members are referring and making members come through the referral channel, which is a very cost-effective channel. Digital is another channel which we have scaled up. And also, if you look at the upgrades, they were again the highest ever, 16% YOY basis. That's another very good story that comes at a very low cost of acquisition, and that's happening. This is leading to a very high growth in the member additions. Equally, the costs are coming down. If I were to look at the resort operating costs, the resort operating costs are also looking very good because we have invested heavily in solar. We are at about 21% of our energy is coming through renewables. We will be, by the end of March, we will be 40% of our energy will come through renewables. So we have a very strong renewable energy usage plan, which is obviously a good move in the area of sustainability, but also very cost efficient and cost effective. So if you were to look at, and by the way, we have also focused a lot on the productivity, particularly in resorts as well as in sales. So all these benefits are accruing on the cost side, and top line is growing because of the actions that we have taken to grow the member additions through the referral and digital route and various other actions. So obviously the benefits are seen in the margin. And also I would say that we are very well positioned because we have a very good situation on the cash fronts. We closed 1,301 crores cash, which is again the highest ever. We also have a deferred revenue which moved up by about 67 crores because in Q3 we had very good numbers. So you can see the deferred revenue has also moved up, which is a big thing for the future because that's the income that will keep accruing into the membership income as we move forward.
All right, but Mr. Singh, tourism as a theme is growing big in India. We are seeing the government's push towards it, as well as a lot of announcements made on that front, and even the private market is also participating in the same. What are the plans for Mahindra Holidays to pick up this theme even larger and make it even larger? What are the plans to expand more into new resorts, as well as what will be the cash utilization for the same, and which method of expansion will you go forward with?
Very relevant question and a very, very thoughtful question. I would like to just give you a very comprehensive reply to this. As you can see, we have about 850 odd crores of capex at play. 700 keys already. In the last calendar year, we started work on 2 greenfield resorts, one in Ganpati Phule, another in Theog in Himachal, 250 crores each roughly. And we, of course, completed the expansion of the Asanora Resort, about 44 rooms at an investment of about 80 odd crores. And we also have plans to invest in the expansion of our existing resorts in Puducherry as well as in Jaipur. We also completed an acquisition of a new resort in Jaipur last year. So a very happy situation in terms of stepping up capex. I think the kind of pipeline that we have, the way we are moving ahead, including acquisitions, we should be looking at a capex in play of about 2,000 crores as we move into the next financial year. But the good news is that since you alluded to the bigger picture of the tourism, and I must say that the fact that Prime Minister's office and Mr. Modi have been constantly, focusing on driving the agenda of tourism, and that's really helping us because the public-private participation, PPP mode, if you were to look at it, we made one resort operational in the year gone by, which is Jhanjeli in Mandi district. We have now a tie-up with Uttarakhand government. We signed an MOU of about 1,000 crores in September in the calendar year that went by. And we have already identified 4 new sites where we'll be putting in about 1,000 crores of investment soon. If you were to look at this quarter, we got the good news that Even Tamil Nadu government is welcoming us, and we have planned 800 crores investment. We have signed an MOU with the Tamil Nadu government. And in Odisha, we have been awarded a new piece of land in Sonpur. Earlier, we were awarded a land in Chilka also. So in Odisha also, we're going to put in about 400 to 500 crores. And in Andhra Pradesh also, we have plans to put in about 500 crores. 2 sites have been identified. So public-private participation, the focus on tourism at the national level is the way forward for Mahindra Holidays and for our nation. And we truly are in sync with the rising aspirations of Indian families to vacation with a brand like Club Mahindra.
Mr. Singh, lastly, let me ask you about what's the average occupancy growth that you're working around with? What's the outlook coming in on pricing? Also, let me add to that point, will you actually go ahead and take advantage of the strong demand and have the package pricing increased by any chance? Because I'm sure that's on the mind of every consumer, given the fact that tourism is on the rise, isn't it?
So the average occupancies have been very robust, 84% in Q3. And by the way, if you were to look at this quarter, January, we closed with about 87%. And if everything goes all right, and with the forward bookings that I can see, we are looking to close this quarter between 87 to 88%. So occupancies are good. Member additions are robust. Price increases are very tactical decisions in our business because we truly look at, what kind of value we are providing to our customers. And our members really sign us up for truly not for price, but the value that we deliver. So I think this price value equation is constantly under review, and at appropriate time, we constantly do a bit of adjustment here because we do provide a lot of value. And as a result of it, sometimes the price increases happen. And if we feel that there is no major, a change in the value proposition, and we are okay to hold down the prices as well. So I guess that's a very tactical move that we will take, and we constantly review it. And that you also, in a way, alluded in your question as well.
And thank you so much, Mr. Singh, for joining us on the show to talk about the way forward going ahead for Mahindra Holidays, as well as all the best to you for all of your future endeavors. It was great interacting with you on this on podium. But thank you so much, Mr. Singh, for joining us on ET Now today. And that was Mr. Kavinder Singh, who is the MD and CEO at Mahindra Holidays and Resorts, talking of the earnings and the way forward going ahead for Mahindra Holidays. As you can see, the stock right now trading higher by about 4.5% or so. On that note, we'll actually slip into a break on this edition of Buy Now Sell Now. When we come back, we have another management joining us. But yes, we will be taking your queries as well, viewers, so don't go anywhere. Welcome back. You're watching Buy Now Sell Now on ET Now, and as promised, we have another management joining us on the show, given the fact that it is earnings season, and we have Bank of India, which had announced its earnings earlier on. And if you look at the stock price right now, it's trading low by about 5.9% or so. Let's bring on board Mr. Rajneesh Karnatak, who's the Managing Director and CEO at Bank of India. Very good morning, sir. Thank you so much for joining us on ET Now. And actually, let's put the focus right now on the profitability in particular. Your interest expenses have increased sharply, leading to a decline in your net interest income. If you look at the yields on advances was also lower. If you could tell us what exactly led to this scenario and how yields on advances will shape up going ahead for the bank?
Yeah, if you see our results for the 9 months, so operating profit has come down sequentially also, and YOY basis it has improved. So as far as the net profit is concerned, it has improved sequentially and YOY basis. So the net profit has increased by 62% on a YOY basis. On the 9-month basis, it has improved by 82%. Similarly, for the operating profit on the 9-month basis, it has improved, and it had shown an increasing trend of around 14%. So you are correct that the yield on advances has come down because of the simple reason that there is pressure on some corporate advances where the margins are thin. And the cost of deposit has also gone high because of the cost which is increasing in the last quarter, in the December quarter, which has increased. So the net interest margins have come down, but the pressure will not be there in this quarter. We'll be able to protect the NIMs for the simple reason that there is a huge franchise with us, and our CASA ratio is around 44%. If you see our retail term deposit in the presentation, it is also at 44%. So our bulk deposit is only around 12% of our total domestic deposit. So 88% of our deposit being retail term deposit and CASA deposit. So our cost of deposit is on a lower side, and it is below, well below 5% level.
Good morning, Mr. Rajneesh. This is Shrishti also joining in, talking about your NIMs that have also come down this quarter.
See that our 9 month NIM is at around 3%, yeah, at a global level. But if you see the domestic NIMs, it is at 3.3% on a 9 month basis. And for the international, it is 1.3, 1.4%. So NIMs, whatever they are at the present December moment, so they will be able to protect these NIMs, as I said earlier, that we will be aggressively going for retail term deposits, CASA, with the help of our franchise. So we are having 5,100 branches, out of which 60% branches are in rural and semi-urban areas. Then we have ATMs and CRM, they are another delivery point for us. And then finally the BCs, business correspondents, which are around 19,000. So Bank of India has a strong franchise of around 32,000 delivery points for our customers. With improved customer service and customer experience, we are very much sure that our reliance will continue to remain on retail term deposits and CASA deposits, and less on the bulk deposits, which is only 12% as on December. And with the growing of our RAM book and improving in the overall margins on the credit side and the reduction in the SMA book and also in the reduction in the NPA, we'll be able to protect our margins, operating profit, net profit, and also the NIMs.
Right, sir. Let's now put focus on your asset quality, which has actually seen a good recovery if you look at it on a quarter-on-quarter basis, be it the gross NPA levels or your net NPA levels for the matter of fact. And apart from that, your slippages also were low. Can we expect now this sort of a trend to continue going ahead? Can we expect a healthy asset quality going ahead? And what's your internal targets for NPAs, if there are any, and if you can share it with us?
Yeah, so if you see our gross NPA, it has touched at around 30,000 crores. YOY, it has come down on the amount wise at around 8,000 crores. On the percentage terms, we are at 5.35% of the gross NPA, which used to be at 7.27%. So our gross NPA on a YOY basis has already come down by 2.61%. On the net NPA side, our number is at around 7,000 crores. And on a YOY basis, it has come down by 20 basis points. As regards the slippages are concerned, so the fresh slippages during the December quarter was only 1,300 crores, and against which the total recovery plus the write-off was around 2,700 crores. If you see the 9 month basis also, the recovery was much higher than the total recovery, and the write-off was much higher on a YOY basis, on a 9 month basis, than the fresh slippages which have taken place. So as regards the guidance is concerned, so for March 24, we are giving a guidance of around 5.10% for the gross NPA and at around 1.30% for the net NPA.
And lastly, Mr. Rajneesh, your credit deposit ratio rose to 80%, while your corporate book, 45% of the total book, grew by 8% this quarter. But post-elections, the private capex is likely to kick in. Are you well placed in terms of the liquidity for the growth opportunities?
Yeah, so if you see our CD ratio, it was at 79.3% as on December. So where as far as the CD ratio for March 24 is concerned, it will remain nearly at the same level. See, as per the RBI regulations, we have to keep the SLR and CRR. So SLR being 18% and CRR 4.5%, aggregating 22.5%. The ideal CD ratio in that manner, as per the regulatory guidelines, is around 87.5%. So 79. It is 77.5%. So 79% of CD ratio is quite comfortable. This is what we feel. Apart from that, let me bring to your notice that we are having excess SLR also to the tune of around 30,000 crores. That will also help us for any incremental growth in credit, whichever happens during this quarter also. We have a robust pipeline of say around 50,000 crores as far as corporate credit is concerned, including RAM credit. So there should not be any challenge as regards the CD ratio is concerned, because as I told, we have excess SLR of around 30%, 30,000 crores, and it will help us improve that. And the incremental deposit also, which we will get in this quarter, on both on the CASA side and the retail term deposit side, will help us keep our ratio well below 80% mark for March 24 also.
All right, sir, we leave it there then. Thank you so much for joining us on ET Now to talk about the quarter gone by for Bank of India and where you see it go ahead, and also all the best for the future quarters. That was the management of Bank of India joining us on the show. Actually, let's take a note of the markets then. As you can see on the bottom of the screen, you have LIC that's finally hit a record high level, surpassed the 1,000 rupees per share mark, and the markets are actually at the levels that they were. You have Nifty above that 21,900 mark. But on that note, we slip into a break on this edition of Buy Now, Sell Now. But before that, viewers, ET Now and ET Now Swadesh, in line with helping Indians rise with India, have partnered with Sundar Mutual to launch the Nivesh Day, which is a groundbreaking campaign to help viewers build their personal finance portfolios through regular and disciplined investing. Nivesh Day is celebrated on the 5th of every month, which is today. So join ET Now Swadesh and Sundar Mutual to learn how you can build your financial future with an SIP in mutual funds.
Alright, then with this, it's time to slip into a very short break. Don't go anywhere, viewers. As we come right back, it's time to take all your stock-related queries. So stay tuned and start writing to us. Welcome back to Buy Now, Sell Now show, where we get you answers to all your stock-related queries. And today onto the show, we have Kunal, both on the technical side as well as Ashish Maheshwari on the fundamental side to guide you better. But let's kickstart taking all your queries then. And the first query that I have, Kunal, is coming in from Sangeeta, and she wants a take on SAIL. She's holding 500 shares and her buying price is just 136 rupees. At this point in time, can she hold, sell or add more to the current quantity, and wants to know the target for the next 3 months?
I think you should continue to hold on since the time frame is 3 months, because my sense is SAIL has just given a fresh breakout on the charts. In fact, many of these metal stocks are finally looking very attractive on the short-term time scale. So I believe SAIL is something which you should hold on. Even if this metal rally plays out for say another 2-3 months, you can expect at least a modest 10% to 15% upside for a stock like SAIL. So I would suggest a hold.
All right, this one is coming from Srinath, who's writing to us from Chennai, and Srinath has two queries. One is on Mazagon Dock, 100 shares at a price of 2,300 rupees per share. He wants to know whether he should add more now or to average it down. Also, what sort of a short-term target, Kunal, you have in mind for Mazagon Dock? And also, the other one, I will take it to you actually, Ashish, and he wants to know, is it good time to buy Suzlon right now? Kunal, first.
Over the medium term, short term wise, I'm expecting some bit of consolidation. So you might see a staggered uptrend coming out for Mazagon Dock. I think at 2100 plus levels where the stock is sitting right now, we can expect that in the next 6 months to 9 months, we can expect at least a 10% up move further for the stock. So very nominal kind of an upside you can expect, but the stock has a capacity to even surprise positively. So keep a time frame of 9 months at least and look out for at least a 10% upside, which means closer to 2400, 2450 could be a target which you can align for Mazagon Dock.
And what's your take coming in for, is the right time to buy this particular counter, and should one actually buy this based on fundamentals?
There are both positives and negatives at this price point in Suzlon. If you see the now market cap is almost at 66,000 crores. So which make it stock expensive. Only solace is that FIs are continuously buying this stock. They have increased their holding from 7 to almost 18%. But at the same time, company has also reduced their debt, and maybe in next quarter they'll be debt-free kind of company also. But only thing is, finance fundamentals are improving. Net profit just became double from quarter to quarter. But valuations are also skyrocketed in no time. So my suggestion will be, instead of Suzlon Energy, better look at stocks like SJBN or NHPC, which will be direct beneficiaries of the solar spending which government has proposed.
All right, moving on to the next query. And Ashish, the next query is on NMDC. All these PSUs have seen a great rally, and Sushil Kumar is holding the stock at a price of 119 rupees, almost a doubler for him. Is this a good time to book out profits or continue to hold on where he can stay invested for the next 6 to 9 months? Ashish, this query is for you. Okay, I think we have got a patchy line with Ashish, but Kunal, any take on NMDC?
Yeah, I'm bullish on the stock, and a couple of months back, in fact, a few months back, I'd mentioned a target of 280 for NMDC going into 2024. Stock is currently now at 243. It's done pretty well so far, even in this month, up some 10.5%, and for the year, it's up some 16-17% for itself. Looks attractive. Will maintain the course of the targets for 280 And in case if the stock happens to come closer to those targets, say in the next couple of months, we could probably revise it on the upside by trailing the stop loss.
All right, the next query is come from Ian Ann from Bangalore, and Ian has Ceylon Exploration at a price of 445 rupees per share and Aptec also at a price of around 344 rupees per share. Ashish, what's your take coming in on Ceylon Exploration as well as Aptec? Do you think both of these counters are worth keeping in the portfolio for a longer period of time? Because as you can see, Aptec is off the buy price because the buy price is 344, while Ceylon Exploration buy price is 455, making profits in that one.
In fact, Ceylon, the stock is already at 50 to high, but it still looks good because again, we have seen their last quarterly numbers also from 0 to 24 crore kind of profit company has declared. And the kind of order books now these companies are building up. So Ceylon Exploration, I think, will be a good bet even at this price point. I'll advise to remain invested, and those investors who are looking to enter into this sector, 500 will be a good price to buy. As far as Aptec is concerned, I'm not that bullish on this stock. We have seen a lot of correction from 400 rupees in Aptec, and now stock is at 260 to 70 levels for quite some time. In my view, you can exit this stock because I don't see any bright future for the Aptec shareholders in short term. I think instead of this, if we want to bet in this particular sector, so we can look at stocks like Coforge or Persistent Systems, which can give you better returns in mid-cap IT.
Right. The next query that I have, Kunal, is coming in from Vivek, and he wants an advice on three of the stocks in which all three of them he's making almost 100% profit. He wants an advice on Voltas, Minda Corporation, as well as JK Paper. What's the view ahead, maybe for the next 1 year, and any advice to like book out profits in any of these names?
Voltas, JK Paper and
Minda Corp.
Minda Corp. So Voltas is something which looks attractive, but the stock has a minor hurdle at 1100 mark. So I think I'll probably wait out for the stock to clear up this hurdle, and then it'll start to look attractive for a target of 1300 plus. Minda Corp on the other hand has been more of a consistent stock, trading at 400 plus levels right now. Again, coinciding with a very interesting pattern of the stock reversing back towards its 50 DMA, bouncing off from those levels time and again. So that could be a good strategy where you can continue to hold on, and closer to 50 DMA for the stock, you can look to add the stock. And the third stock which you mentioned was JK Paper. So I think if I'm not wrong, paper stocks have gone through a correction in the last 1 week. JK Paper also I think has gone through a correction. It's come back towards a 50-day moving average. So currently it looks attractive, but in case if the stock bounces back and say comes back towards 440, 450 mark, could be a good strategy to book out profits there and look to buy back on dips.
Sorry, Kunal, another one coming your way. Indus Towers as well as Tata Communication. Pratiksha from Oman is written, and she's suffering loss of approximately 2% in both of these holdings. So she wants to know whether she should average it out or exit or stay put with this counter for a period of 6 months or so.
I think you should stay put. I think both these charts are evolving quite well. Tata Communication, I think, had a fabulous uptrend, and now it's going through its own patch of consolidation. It's come back towards the or it's rather very close towards the previous support of 1660, 1680 mark. So maybe another 30, 40 point correction to the stock, and I believe it could tap back into a strong demand zone. Same is the case with Indus Star. The stock could probably bounce back again from its 50-day moving average, which is closer to 205 levels for the stock price. So both charts are attractive. They are coming back towards a mean reversion phase. Once that is completed, I would believe that the uptrend should resume for both of these stocks.
All right, moving on then. And Ashish, what's your take coming in on Granules? Bishaka from Kolkata is holding 50 shares at a price of 316 rupees. Should he continue to hold on or rather make a switch to stocks like NTPC or GAIL at this point in time?
Granules is again a good performer stock in pharmaceutical sector. If we see from 270 stock has in 435 level recently and still at 427, 28 level. And market cap wise also quite attractive. So though PSU stocks are performing well, but I think Renewal I'll put in list of performer stocks only in pharmaceutical pack, and numbers wise also for last 1 year they haven't disappointed at all. So remain invested will be my strategy for Granules India.
Right, so that's the take coming in on Granules. The next one that I have is coming in from Sitaram, who's writing to us from Chennai. And Kunal, for a short term period, that is less than a month period, makes sense to invest in HFCL or even for the matter of fact SPIC? Do you think these counters make the cut, and can one even expect returns of about 15 to 20% in that period?
So I think both these charts are attractive, but I think out of the two, HFCL is something which has gone through a pause. I think the rally is halted for the stock right now. I think closer to 100 rupees. For SPIC, the stock is at 105. In the last 3 days, the stock has already run up from 80 to 83 levels to now 105, which means I would sense major part of the uptrend for SPIC on the short-term time scale is behind. Ideally, we've seen many of these times that these stocks, when they move up by a margin of 15-20% plus in a span of 3-4 days, then these stocks are bound to get into a couple of days of correction. So buying on dips for SPIC could be a good strategy, and for HFCL, you can consider buying at current levels. 96, 97 is a good support for the stock over the very short term.
All right, Kunal, once again a query for you, because viewer wants a technical check on this one. He didn't mention it. Okay, his name is Vivek, and he wants a technical check on Taj GVK Hotels, where he has bought the shares at a price of 230 rupees. For the next 1 year, any targets on this?
I think it's an excellent chart, and the stock, if I'm not wrong, has just confirmed a very big breakout. It's a multi-year breakout for Taj GVK. The stock on the closing basis specifically. So I would sense that if it sustains about this level of 300 plus, 285 I think is the breakout on the long-term charts on line chart basis. And if the stock sustains about this, say 300 odd levels as a round figure number, then you could probably expect the stock to head towards even levels of 350, 400 over the next 6 months to 12 months. And possibly the upside could be much more higher over the next couple of years. So it depends on how long you can hold. But I believe that the stock, if it sustains about 300 levels, the upside could be significant over the next couple of years and more.
Ashish, coming to you, and this one is also coming in from your namesake, Ashish, that is, and he wants to know whether it makes sense to look at Jio Financial or Bajaj Finserv at this point in time. He's planning to buy one of those for a period of about 2 years or so. Do you think that both of these counters stand to benefit with what is exactly happening with Paytm, and keeping that in mind, you think one should look at these counters, or the fundamentals for both of these counters warrant a buy?
You ask me, my bet will be Geo Financial. Because the way post their quarterly numbers, the stock has bounced back. It looks like that a lot of institutional participation is building up in this stock, and the stock is almost near 50 to week high. So my out of these two stocks, my bet will be on Geo Financial, and my target for this stock will be 300 in short term. As far as Bajaj Finance is concerned, I think whatever the market share they are going to lose, companies like Geo or Piramal are going to gain. So Bajaj Finance is not in my buying list at this point of time.
All right, so that's the take coming in on Bajaj Finserv. But with this, viewers, it's time to slip into a very short break. Don't go anywhere. We'll be right back.
Welcome back. You're watching Buy Now Sell Now on ET Now, and let's bring on board the management of Star Health and Allied Insurance, Mr. Nilesh Kamli, who is the CFO of the company, to talk about the Q3 earnings gone by and what do they expect going ahead. Very good morning, sir. Thank you so much for joining us on ET Now. And Star Health's agency growth has actually been has continued to be slow in Q3 as well, with the channel growing by about 16% versus 17% in Q2 versus, and if you compare that in the preceding quarter as well, that's 20% in Q1. Is this downtrend likely to continue in Q4 as well? And also, by when can we actually expect about 20% growth levels coming in for Star Health?
So the decline in growth is by design and choice. We continue to focus on quality business with a. So we have made certain changes. We are focusing on quality business. We are likely to grow in line or higher than the market growth rate for the short term and medium term as well.
Very good morning, Mr. Kamle. This is Shrishti also joining in. But just wanted to understand that is this a conscious call to lower your volume growth to foster the higher profitability?
See, basically, yes. The approach is to ensure that, the business that we are underwriting continues to be profitable. We just don't want to grow for the sake of growth rate. There are certain geographies, there are certain categories like the portability segment where the loss ratio is very, very high. So we don't want to do something just for the sake of growth.
About your long-term loss ratios, they were actually higher than the company's target of about 63 to 65%. Could you give us a guideline as to by when, or sorry, timeline, I beg your pardon, by when do you see it coming down?
In the month of November, December, and Jan, the loss ratio is trending really well. Historically, Q4 is the best quarter when it comes to loss ratio. We are confident that we should be able to bring down the loss ratio for Q4 and for the full year. We are not giving any guidance when it comes to full year loss ratio, but yes, on a ongoing basis, again for the next year and years to come, we'll ensure that we'll continue to do well and keep on improving on the loss ratio.
And also, Mr. Kamble, the industry continues to face challenges of the high medical inflation, leading to a struggle on the profitability. Now, this is despite an increase in your tariffs. So where is this headed? Any further price hikes on the cards, and by how much? And what would be the impact on the margins as well?
So when it comes to Star Health, we had taken a price increase in our flagship product, which is Family Health Optima. That is going on really well. When it comes to other products, we continue to evaluate the portfolio reduced for Star Health. So there are various steps which we are taking. The preferred hospital networks that we have created, we have negotiated rates which are very, very good. So while the medical inflation is higher, when it comes to Star Health, because of the volumes at which we operate, we are able to manage it very well. And going ahead, on an ongoing basis, we'll continue to bring in efficiencies when it comes to claim settlement.
Right, the management actually rolled out change in the incentive structure for agency channel in Q2. Is this exerting any pressure on your business by any chance? And also any price revisions that are impending right now?
See, not really. As a thought leader and as a market leader, we continue to experiment when it comes to various options. We had evaluated certain schemes to the agents. We have tweaked those schemes. The output has been really good. The agents are also ensuring that it's not only about growth, but it is about quality of the business and a long-term sustainable business model. So unless there are profits, that business that you return is not useful. So everyone is understanding the importance of quality business, and that's our objective. So that's taken up really well by the market. And yes, we continue to make some tweaks to ensure that we grow a quality business.
And also, Mr. Kamble, the analysts expect the digital and the banker to contribute significantly to the new business going forward. What is the strategy here, and how much could these segments contribute going forward?
Currently, banker is 5% of our business. Digital is around 7 to 8% of our business. These channels are growing really well. When it comes to fresh business, they are contributing 33% of our fresh business. In the near term, long term, we expect these businesses to contribute around 50% of the fresh business. We have done a lot of investments. We have tied up with a lot of partners in the banking and NBFC space, and these are giving us really good results. Around 50% of the fresh business will be contributed by these two segments in the near term.
All right, Mr. Kamble, we'll leave it there. Thank you so much for joining us on ET Now to talk about Star Health's performance in the quarter gone by and the way forward coming in for the company. And that was Nilesh Kamble, who's the CFO at Star Health. But with that, we are totally out of time on this edition of Buy Now Sell Now. It's a goodbye from Shrishti, myself, and the team that put the show together. But stay tuned. Markets Noon coming up next.